Welcome to the Robotti & Company 2020 annual meeting. For those of you who haven't met me virtually or in person, I'm Lindsay Rubenstein, the head of marketing and investor relations for the firm. Last year, I gave these remarks to a full room at the Yale Club, where we've held the meeting for the past several years now. And well, this year, it's obviously different. While we're not physically in the same location, we have the flexibility to be joined by a wider and more global audience. So good morning, good afternoon, or good evening, depending on where you are. We'll keep these opening remarks short since there's a lot to cover. We're going to start with commentary from our founder and CIO, Bob Robotti, and portfolio manager of our ASIA strategy, Curtis Jensen, followed by Q&A facilitated by senior investment associates, David Kessler and Theo Vandermeer. The goal is for the entire dialogue to be conversational in nature. As echoed in prior meetings, our success is greatly due to those with us today. Both our existing investors, we thank you for your continued support, and the entire Robotti team who is also participating. Your everyday efforts are very much appreciated. When we noted in our year-end letter that came out this past January that this new decade would be unlike any other, well, we did not know how true those words would be. The advent of COVID, though proving challenging, also has proven our resiliency, with our business operations and investment strategies continuing uninterrupted and changing the way we've been able to communicate, opening up new pathways and technologies for FaceTime. This new world enforced the strength of our relationships with you, as well as with the executive managements of our investee companies, with whom we've been able to communicate seamlessly, frequently, and consistently throughout the pandemic, underscoring the importance of the nature and tenure of these relationships, especially in these unprecedented and unpredictably volatile times. Now, before we get started, in terms of logistics, all participants have been hidden from view and placed on mute. Please use the Q&A icon below to submit any questions that you haven't done so already in advance. So, as I think you'll hear from the team today, when it comes to fundamental, timeless, rational value investing, we are very enthusiastic about the opportunity set at hand. And with that, I'll turn it over to you, Bob.
Thank you, Lindsay, and thank you all for being here today with us. We appreciate it. As Lindsay highlighted, of course, the format's different, but the message is exactly the same. There's been a consistent message to our investment approach over the 35 years we've been around, and that is we are unabashed value investors, right? And that's across the firm. So whether that's Curtis Jensen, who'll be speaking later today about his ASIA investment approach, whether that's David Kessler and Theo Vandermeer with me here today, whether that's next week, Isaac Schwartz will be hosting our annual meeting for the Global Fund, there's a consistency of approach to investing across that entire universe. So that's what I'm going to start off with, giving you what does that mean? What do we interpret being a value investor means? And we'll give you a view as to the current environment and how that affects it. So a worldwide pandemic, political and social unrest, and how potentially those things actually create opportunities. So the first one I want to start off is, what is value investing? And of course, the security analysis is the seminal work by Ben Graham, which kind of started that investment approach. And that's a key indicator of what it is. It is individual stock research, bottom-up investing is a critical element of our investment approach. Now, the way it's, of course, done today is different than when Graham first wrote his text. Back then, he wrote it in the middle of a depression. So he bought stocks that had low price to book, low PE ratios, high dividend yields, and that was the approach. But the intention all along was looking at individual securities, analyzing those companies, making determinations as to what a conservative fair value of that business is, and buying those businesses for less than what that value indicated. And of course, why is that a potential opportunity? So Ben also spent a lot of time talking about investors, the irrationality of investors, the emotion of investors, and how that affects security prices. So a fundamental part of value investing is the disbelief in the idea that there's an efficient market, that every security properly evaluates the future cash flows of that company discounted down to today. And there's plenty of reasons, and an important behavioral bias that Graham spoke about was the idea of recency bias, right? What is today and what was yesterday is projected to be what will be tomorrow. And frequently, yesterday and today are not the rate indicators for the future opportunity. So it's looking at businesses, understanding those businesses and making conservative estimates of future values. That is a key determinant. So it's individual security analysis, belief that securities frequently can be mispriced. The longer they're mispriced, potentially, the more they're mispriced. And if you've done that sober analysis by someone who's an experienced investor and made conservative estimates, that gives you the opportunity for both returns, and of course it mitigates the risk in it. So the margin of safety that Graham also spoke about. So those concepts and precepts continue throughout our investment approach today. And we think that the world and the environment in which we're in today, the companies that we're invested in are particularly attractive on a go-forward basis. So with that, I'm going to turn it over to Curtis. Curtis, why don't you give us your view on the markets?
Well, thanks, Bob, and good afternoon, everybody. Thanks for joining us. As Lindsay said, we really are grateful for your support. I'm Curtis Jensen. I manage the ASIA Partners strategy. Whoever coined the phrase, "May you live in interesting times," might have had 2020 in mind. I know it's been one of the more challenging years in my career, and I'm already looking forward to next year. But I wanted to make 2 points this afternoon, and I'll start maybe by linking back to something I said at last year's meeting, and that was around these labels of value and growth. I think there's a little bit of an artificial distinction. And last year I made the point that there is no value without growth. And I think I would refine that a little bit. I mean, the best investments that I've made in my career really have had elements of both growth and value. So if you think about this maybe as a Venn diagram, right, where there's value in one circle and growth in the other circle, where those two circles overlap is what I think of as a rational investing approach. So if you're allocating capital or you're thinking about making an investment, you might reframe the conversation and rejigger it a bit to think more about in terms of whether something is a rational approach rather than framing it in terms of growth or value. You know, our goal this afternoon is to give you really a sense of how we think, how I think, Bob, Theo, and David, and how we think, and that you walk away with the sense of that what we're doing is indeed rational. So the second point I'd make relates specifically to the portfolio. You know, huge amounts of capital have been allocated by pensions and endowments, family offices, into private equity. And you know, that flood of capital is only really accelerated with the last decade of low interest rates. And I don't see that flood sort of ebbing anytime soon. When I consider the ASIA Partners strategy, what strikes me really is how much of the portfolio is very private equity like. And you know, the holdings really come with some important advantages over traditional private equity. So the characteristics of the portfolio really create outcomes that are quite differentiated from the general stock market, and therefore potentially create a valuable diversifier for investors. So hold those, you know, two thoughts in mind. We can unpack them a little bit in more detail as the afternoon progresses.
Thank you, Curtis. Again, as Lindsay said in the beginning, we really do want this to be an interactive meeting. And so we encourage you all to ask questions through the Q&A platform that's on Zoom here. We actually already have a couple coming in, which is great. And we encourage you to keep asking them. Hopefully we can answer all of them, and we're going to do our best to do that. But to start us off, I think I'll ask Bob a question that is probably on a lot of people's minds today, which is, Bob, when do you think that we'll get back to some semblance of normalcy?
Thanks, Theo. I guess the important thing in my mind is to emphasize the last part of the question, back to some semblance of normalcy. The key in my mind is the current situation with the pandemic is not the new norm. And that's frequently what we're talking about is behavioral biases. People anticipate the current situation and project it into the future. And so we do think this is a transitory issue. We do think, we don't know if it's 6 months or a year or two, whether there's a vaccine or some other solution, but this is not the new norm. So the importance in thinking about the pandemic is, or political unrest and social unrest, all of those things are, we're looking to invest in businesses and make estimates as to the future cash flows of that business, the present value of those cash flows, and how much will accrue to equity owners. So the important question is, okay, so what's the impact in the business? How does it change those future cash flows? How does it potentially reduce some of those cash flows in the short term? How long does that last? How big is that impact? But also, what things are unleashed? What trends that potentially were underway are actually accelerated in the process? And in certain situations, we clearly believe that a number of our companies actually are quicker getting to a point where the businesses will have significant growth in those cash flows. And the size of those cash flows will be even enriched given events. So therefore, the important question is not when do we get back to normal, because it is estimating the impact of the current situation, how much of it is permanent, how much it is not, and how that affects the valuation of the businesses we're invested in. And we'd also highlight that, of course, the market gets that estimate wrong, and its security price valuation is really an opportune situation for stock pickers like ourselves.
Great, thank you very much, Bob. I have a question for Curtis. Curtis, in your opening remarks, you spoke about the labels of growth and value and about this Venn diagram where value and growth intersect or overlap, leading to a philosophy you've often called rational investing. Just wondering if you could explain how this model of rational investing manifests itself in the ASSIA portfolio.
Thanks, David. I think defining rational investments, there are really 4 key characteristics. Number 1 is I'm trying to identify businesses with strong or improving fundamentals or economics, and importantly, ones where the management team has attractive reinvestment opportunities. Secondly, I'm looking at the management teams and the executives. Not only should they be capable and properly incentivized, but they really ought to be thinking and acting like owners. Very important. Third is the balance sheet. The balance sheet needs to be able to sustain the business in a downturn and really ought to reflect the underlying business risks. Lastly is the delta between public market prices and intrinsic values conservatively estimated. I think, any one of those ingredients in isolation is a necessary but not sufficient condition for an investment. But when you put all 4 of them together, I think you have a really good recipe for what I think of as rational investment.
Thank you. That was very helpful. I have a follow-up. In this crazy year that we've been having, how has this philosophy of rational investing held up?
Well, one of the main points I was really trying to make all year was that there was this huge divergence between public stock prices and intrinsic values. In March and April, for example, you had stock prices declining by 30 and 40 and 50% in a matter of weeks. It kind of made no sense and really just reflected total panic in the markets. I spent much of that period talking to management teams, trying to reassess intrinsic values. What I discovered was that even if you made very draconian assumptions about the businesses, the declines in earnings and cash flow, it didn't impact intrinsic values by nearly the same way that the stocks were reacting. So in effect, you had this widening spread between public market prices on the one hand and intrinsic values on the other hand, even in the cases where intrinsic values declined a bit. Going into the downturn, our holdings didn't really include some of the hardest hit areas. And I'm thinking of things like retail, travel and leisure, and aerospace. But we did own industrials and materials companies. Of course, in those cases, the customer bases were impacted, the operations were impacted. But I was really impressed at how much was getting done by our management teams during the pandemic, whether it was in the area of operations, whether it was executive recruitment, corporate finance, getting deals done, just forward progress generally in our companies. A lot of that business resilience and relative stability and intrinsic values, however, was not reflected in the public stock market prices, even through much of October. Now, some of that's turned around here in the last few weeks, fortunately. I guess the last piece is, we have a long-term investment time horizon, and consistent with that, our core holdings really didn't change that much. I did use the market downturn to add to our core holdings. And I also tried to take advantage of the short-termism and the panicky market selling to upgrade the quality of the portfolio. So broadly, that meant, adding companies whose business models might be described as asset light, or whether it was recurring revenue streams or fee-based revenues. And I'm talking about companies, two examples would be Morgan Stanley and Voya Financial.
Thanks, Curtis. I want to highlight what one of the things you talked about, right? And that is in March and April, securities markets radically adjusted. And yet, in many cases, the business values didn't radically change. Theo, could you talk about one of the investments we made in the quarter, what the market gave us as an opportunity, and what we seized on, and how we thought about it? Thanks.
Sure, absolutely. Thanks, Bob. As Curtis mentioned, we weren't invested in aerospace either going into this, but the opportunities that were presented us due to the emotion that was built into the market allowed us to make a new position in that over the last couple months here. And I think it's important to highlight because it does provide a base case of something that's indicative of our process overall. So we often look at out of favor industries. We find them to be fertile hunting grounds. And when the pandemic hit, there probably wasn't much more out of favor than travel and aerospace. So how we started is we researched the entire industry. We looked at the airlines themselves, we looked at the booking agents, and we looked at the airline leasing companies. And through that process, a similar thread that happens a lot in our research process emerged, which is that we rediscovered a company that we had actually known for a few years leading up to that. And the company we rediscovered was AerCap Holdings. And it's the largest airline leasing company in the world. And basically what an airline leasing company does is they own planes and then they lease them out on long-term contracts to airlines. So your typical airline has anywhere from 20 to 80% of its fleet leased out from a company like AerCap Holdings. So chances are, if you've flown a plane in the last decade, you've flown on probably a plane owned by AerCap Holdings. So to set the stage a little bit for how we came to the investment, before the pandemic, we thought that this was a cheap company because the market wasn't appropriately valuing the platform it had for buying and selling planes. They had also been making really smart capital allocation decisions. They've been aggressively buying back shares over the last few years, and they had been right-sizing their fleet and repositioning assets to move away from older planes that were flying on routes that were less popular and moving to younger planes that were flying the more in-demand routes. And so they were repositioning their assets in a really intelligent way. And so with that stage set, when the pandemic hit, the market priced AerCap and everything that touched aerospace in any way as if it was going for bankruptcy. And it shows the manicness of the market. Suddenly, this was the new normal. And remember, at the beginning, when there was the lockdown, ridership essentially fell to zero for a few weeks. But what the market had done is said that would be in perpetuity and that people weren't going to fly again. And we fundamentally just didn't agree with that. And this goes back to Bob's earlier point about the time horizons. And so we didn't know if a vaccine was going to be developed in 3 months or 3 years, or if we were going to have some system of testing and tracing. But we did think that the eventuality of there being an environment where people would fly again was very, very likely. And so while the timing wasn't certain, the certainty of that happening, we thought was pretty certain. And we're already seeing some encouraging information in that. China's domestic flights have surpassed pre-pandemic levels. There was a surge around Thanksgiving in the US for domestic flights. And although we still have a ways to go, it shows that pre-pandemic or that pandemic fear of no one's ever going to fly again is probably overblown. And we saw the manicness on the other side of things as well. When there was some promising vaccine news, suddenly everything related to airlines and hotels and all that shot up again. And it just goes to show the amount of emotion that's tied into these cyclical and out of favor industries and companies. And it's the reason it's even more important to focus on the fundamentals of the investment that you're looking at. And with AerCap, what we had was a company that, again, owned the physical assets that we were pretty confident we're going to fly again. And they also had the balance sheet and the access to financing that would allow them to survive a prolonged downturn. And there's a saying in the industry, which is that when times are good, airlines need planes, but when times are bad, they need financing. And financing is actually the better part of the business for AerCap. And so they're able to utilize their superior balance sheet to work with the more distressed participants in the industry to AerCap's advantage. And all this is not to say that AerCap didn't face headwinds. They absolutely did. Ridership still has a ways to go to get back to the trend line it was on before the pandemic. They've written down over $1 billion of assets, but that was largely from the part of the fleet that I mentioned earlier that AerCap had been systematically moving away from for years. And so it just accelerated back a retirement program that had already been in place. And this was all baked in when we made the initial investment. We expected there to be write-downs. And in all honesty, we expect there to be more write-downs in the coming quarters. But as with all of our investments, it goes back to the valuation. And the amount that the market was marking down this company was really, really disjointed from what we thought, even in extreme cases, was going to happen to the actual write-downs and the actual fleet that they had. And so all this is to say that the importance of focusing on the long-term future cash flows of the business is paramount. And maybe before I kind of go on too long here, Bob, do you want to talk about some other ways in which that long-term time horizon has manifested itself in the portfolio?
Yes, sure, Theo. It's once again, it's the market looking from the wrong time horizon, thinking that today is tomorrow. Our investments at home building are an excellent example, case study in how this has worked for us, the opportunities the market provides, and how this works. So in 2008, 2009, we were looking at the home building business and thinking, this is an interesting industry. The industry had imploded, worst ever, post-World War II, lowest amount of new homes being constructed. There's a significant amount of oversupply. Too many homes were built. The financing on that, people were getting foreclosures. So the oversupply was significant. Therefore, that new home building fell to very low levels. And there was no appreciation and no understanding and no timeline for when that would be corrected. So we started to look around for businesses that were well-positioned, differentiated in terms of their business, had financial situations that ensured their ability to withstand the situation, to survive the downturn, and importantly, to thrive in the recovery, because clearly those kinds of situations create great dislocations, and for certain well-managed businesses that are financed, the opportunity for substantial expansion. So that's what we figured, right? That the 1 to 1.1 million single-family home number, which has been a 50-year average, and that's when a period of time when the population was half of what it is today and the number of households was half of what it is today. So to get back to that modest trend line, we thought was almost a surety. The timing of it uncertain. So we identified companies to invest in. Now, frequently, when we do invest in cyclical businesses like this and make estimates of when this recovery comes, so often it doesn't happen as quickly as what we anticipated. But in the meantime, things are still happening in the business to those well-managed, differentiated companies that are improving their competitive position and improving their earnings power even before the recovery comes. And the extension of it provides even a greater runway of opportunity. So that's we think, a classic example of something that you've already seen the manifestation of, and we think we're extremely well positioned today. Interestingly, because we still think there's a 10, 11-year period of significant underbuilding, and therefore that means you have 3 to 5 million homes we've underbuilt over that extended period of time. And we've gone from 67% home ownership, an all-time record, down to a 62%, which is a long-time low. And we think there's a lot of underlying trends that already had started to change, that already increased the demand for single-family homes, the interest of people to move out of urban areas into suburban areas, that we think COVID clearly has been an accelerant to that change, and therefore the expansion of the earnings power and the timeline and the realization for these investments.
Great, thank you. Do you want to talk about a specific example, a specific company?
Yeah, the best example of the investments we're talking about are our investments in the distributors to the home builders. So Builders First Source in 2009 and BMC in 2010, post its bankruptcy, we accumulated from a number of the banks who were the lenders a significant equity position in BMC. These businesses are better businesses with product and service offerings that are differentiated. The scale and scope of the businesses give them competitive advantages. The geographic spread of the business is another positive to the companies. So the recapitalization of BMC gave it a great financial position for the ability to participate in the recovery. And of course, that's what's happened, right? So back in August this year was kind of a culminating event. So Builders FirstSource and BMC combined and are merging together to form by far the largest company. And it's not just this consolidation, right? In 2015, both companies participated in a consolidation event. So therefore, you've had a radical change in the structure of the business, the competitive offering of the company, its continued growth in value-added services. So therefore, it's continued differentiation from its competitors, the free cash flow generation of the business as it's less capital intensive. So that's we think an excellent example how a patient investor in a cyclical business has an opportunity for an entry point and a long-term runway for opportunity that even today we think is still in middle innings of a very positive trend for us. And so, but it's in addition to, as I said, we accumulated a large position of BMC. So frequently, we also get very involved with the companies we're invested in. You know, we have relationships with the managements that benefited us in the current downturn because we can access them to figure out what's going on in the businesses, how cash flows might change, but also to speak to directors and understand capital allocation and express our views and to identify ourselves as long-term constructive shareholders. So therefore, we think that boards and managements take into heed what we have to say. In this situation, you know, it exemplifies others too. I became a director of BMC from 2012 to 2015. And we think that was critical because it expanded our understanding of the business, the nuances of the business, the differentiation, the service offerings, the people involved with the business, therefore understanding those dynamics and understanding all of the value chain in a home building business. And we also thought that there were a number of suppliers that also were favorably affected by the consolidation trend. So one of those is Norbord. And David, maybe you've done a lot of work on it. And maybe you'd share with us our investment thesis and where we stand on Norbord.
Sure, thanks, Bob. Yeah, I agree. Norbord actually is a great case study for how we invest. So Norbord is the largest producer of oriented strand board, or OSB, which is a replacement for plywood used in building homes. Now, interestingly, we spend a lot of time speaking about investing in cyclical companies, which is a dominant theme across our portfolio. And I think it's actually one that differentiates us from the majority of investors who list cyclicality at the top of their list of what to avoid. Now, of course, or maybe ironically, the reason we often find bargains in cyclical industries is because there's less competition in such a large segment of the market. But that's just one of the tools or frameworks we utilize at Robotti to identify potential value. So we eventually found Norbord through a company it had acquired because that company was raising capital through a rights offering, which was backstopped by its largest shareholder. That's another tool we use to identify potential value. But once we identified that, we were able to really quickly increase our conviction on the business because, as Bob said, his experience on the BMC board had given him this lens onto the industry to help us understand it holistically. Now, Norbord has experienced most of the same dynamics as builders in BMC that Bob just spoke about. And specifically, it's continued to see the benefit of a more consolidated industry over the past decade. Now, with what's a somewhat fixed amount of supply currently available in North America, the survivors have become more dedicated than they've ever been in the past to producing only what they can sell. And this rational, disciplined production will eventually result in a more rational and less volatile pricing, which will favor the OSB producers. Now, interestingly, right now, we're in the midst of what Charlie Munger might call a Lollapalooza effect. So initially, when the pandemic hit and we entered lockdown, Norbord stock was hit especially hard because of its economic sensitivity. And management quickly responded imprudently by enhancing their balance sheet liquidity, but also by curtailing production capacity. The curtailments they took was on top of what had already been taken offline in the second half of 2019 as the business focused on matching production with demand. Now, of course, I don't think anyone predicted is that instead of a pullback in housing demand, the pandemic would actually be the catalyst to unleash this previously dormant demand for new homes. The one we initially identified that Bob just spoke about, and that was one of our key investment factors underlying our investments in the home building industry. And when this surge in demand for single family homes meant an even more limited supply of OSB, economics 101 took over and the price of OSB skyrocketed to all-time highs. Now we do expect that prices will moderate from the unusually high level they're at. But we also believe that the dynamics are now in place to sustain a disciplined pricing environment for a considerable period of time, allowing Norbord to have an extended runway to produce significant amounts of free cash flow. Now the stock's up an astonishing 330% from its March low, and it's currently up just over 45% year to date. But just 12 days ago, West Fraser, which is a Canadian-based producer of lumber and wood panels, made an all-stock offering to acquire Norbord in a transaction that, once it goes through, will value the company at $37.78 a share. Now, we're still in the process of doing our diligence on West Fraser so we can understand the impact of our unchanged thesis on OSB and Norbord, how that will impact the new business combination. And in fact, we look forward to speaking with West Fraser's CEO later this week, which is an important part of the diligence we do, as we make sure we're invested in the securities of the business or businesses best positioned to take advantage of what we really believe is a tremendous multi-year opportunity. Now, one last thing I want to point out, Curtis, as you know, Norbord and the company that we originally invested in, Ainsworth, at the time, were both more than 50% owned by the private equity arm of Brookfield Asset Management. And Brookfield actually still owns 43% of Norbord. And remember, you mentioned in your opening that many of our investments are very private equity-like. Here we have an example or evidence, because it's still a public company, of an investment that is clearly, based on their investment, private equity-like.
Yeah, sure. Thanks, David. Maybe I'll make a comment before I segue over to the private equity theme. And I think the discussion with Bob and you and Theo is interesting in terms of, it really illustrates our investment process in so many ways. I can think of at least three aspects. I mean, number one, for example, is just how we search for ideas, right? We're not necessarily using quantitative screens to chunk out statistically cheap stocks. We're looking at a whole industry. We're looking up and down the value chain in that industry and looking at the profit pools within the industry to determine whether or how or if we might participate. Secondly is, how we engage with the management teams and boards. Bob has been on a number of public company boards. I've been on 2 corporate boards. So we have a sense of, and some experience in how to engage management teams and boards, and importantly, how to engage them constructively. And thirdly is just sort of backing up and being aware of change within an industry, right? And how it can affect the players. And here you have building materials industry going through consolidation and all the impacts that can have on our individual investments. So kind of turning to the private equity theme, and as you mentioned, of course, Norbord is owned as one of its largest owner is Brookfield, a preeminent private equity firm. I suppose when you think of a traditional private equity company or a private equity fund, one thinks of a highly leveraged balance sheet, one where the owners are sweating the assets like crazy. I think our version of private equity is a massive departure from that template, and one that offers, I think, some benefits over traditional private equity. If you did a side-by-side comparison, kind of our version of private equity with traditional private equity, of course, you'd find a permanent capital base. You'd find engaged owners and executives. And, there are important elements of control in each case, but our holdings have at least 3 or 4 advantages over traditional private equity. Number one is liquidity. And liquidity doesn't matter until it matters, but we're dealing with publicly listed securities. Our companies tend to be run with low overhead, and of course, they tend to have lower financial leverage, which means a different kind of risk profile. Lastly, when a traditional private equity firm wants to buy a publicly listed company, they normally have to pay a significant control premium. If you look at the ASIA holdings today, 3/4 of the portfolio are invested alongside, shareholders, whether they be founders, groups of executives or like-minded control groups that have at least a 20% economic stake or 20% voting stake. So they've got hundreds of millions of dollars, and in some cases, billions of dollars invested in these companies. And that's, to me, that's real skin in the game, and it's not other people's money. So, I've been attracted to these kinds of companies because their owners, their executives and their boards really think about long-term wealth creation. They don't really care about quarterly earnings. They tend to finance the businesses very conservatively, and they're reinvesting in the businesses appropriately to protect the business and grow it over the long term. So if you're like me and there's a sleep at night factor in your investments, then I think these kinds of companies and these kinds of investments make a tremendous amount of sense.
Thank you, Curtis. So I want to make sure that we leave enough time to answer all these questions. We already have a lot rolling in, and we encourage you all to continue submitting them, and hopefully we can get to every single one of them. But before we switch over to Q&A, Bob, Curtis, are there any final thoughts you would like to share?
I'll take a first stab. I guess I'm kind of reminded of something that I think David Swensen said or mentioned, and he really kind of equated success in investing to doing something that's uncomfortably idiosyncratic. And I think our results ought to be much more tied to the idiosyncrasies of the individual companies, much more so than what's happening to the overall stock market. And I think a case that illustrates really both of the themes that I've mentioned today is CPL Resources. This is a temp staffing business that is 30% owned by its founder and CEO. I highlighted it at last year's meeting as being sort of emblematic of our kind of investing. In early November, the company agreed to be acquired at a 36% premium to its share price. So our outcome is really a pleasant one, but it has nothing to do with the general stock market. I mean, the discussions in this case between the buyer and the seller were going on for many months with all the uncertainty surrounding it. And I believe the kind of owner operators, the internal activists, as I think of them within our companies, will continue to create value, irrespective of what's happening in the economy and irrespective of what's happening in the general markets.
Great. So with that, I guess we'll start to answer some of these questions here. So we have several questions that are fairly similar, so I'm going to do my best to combine them. But a couple people have noted that we highlighted some of the opportunities COVID offered us in housing and aerospace, but they also noted that it's been a headwind to energy, and they're curious how we're navigating that issue. They've also noted that BP's investment in green energy and how we think about that. And so maybe Bob, if you want to start us off there.
So we've been investors in energy broadly for 40 years, and the energy business has radically changed and evolved over that period of time, and it continues to evolve. So when we look at the conventional oil and gas investments that we're in today, and at one time the coal investments we were in, we look at what's the alternatives, what's the competitiveness of those things. And so one of the things we did do in the downturn is, once again, had spent a lot of time looking at solar, understanding its increasing economic likelihood of participation. And we did invest in a company called Canadian Solar. We think it's Theo had done a lot of work over the years, and the market gave us an opportunity. So there was an entry point. I also note that a lot of our conventional oil and gas investments are service companies. We tend to want to invest in the guys with the picks and shovels, who have more sustainability, we think, in the business, and more of an understanding as to what the earnings power of those businesses are. A lot of those companies also are tended to be focused on offshore oil, which we actually think offshore oil and gas, because gas is a growing component of that market too. So therefore, that's part of our business. And then, of course, the evolution of those companies is not only are offshore oil and gas fields being developed, of course, offshore wind is a growing business that clearly looks as it has a very long runway of growth. And of course, one of our core holdings is Subsea 7, who clearly has been in that business, increased its participation, acquired related companies, extended its involvement, and so therefore really has grown out with relatively limited capital investment an extra leg to that business, and therefore like a great opportunity. At the same time, its core business is differentiated, it's consolidated, it's more differentiated than it was, and therefore the earnings power of the core business we think is clear and positive. Now, the idea that BP and what BP is doing, I would suggest from 40 years of following major oil companies, a mistake that they frequently make is, well, if we're in the oil and gas business, we should get into the coal business or renewables. And whenever they get into those businesses, it seems as if it's very difficult for them to be successful. I would think that BP would be better off making distributions, returning money, capital to shareholders, and reducing its investments if that's what they want to do, but not trying to reinvest and invent themselves as a renewables company. So, but I would observe that it is, a clear, right? I'll also digress for a moment here too. It's oil and gas clearly is a growing component of the business without regard to renewables. It is part of the equation. Part of what enables the renewables is sustainable and predictable power generation. So natural gas is a low-cost way to do that. It's continuing to take share, and that's broadening out the opportunity in a lot of things that we're invested in. As for oil, which is the headline that everybody focuses on, and the volatility, I'd suggest to you that the oil business is going through long-term trends that take time to unfold, right? And what you saw is U.S. onshore oil shale changed the equation in the last decade. It's continued growth for an extended period of time, oversupplied world oil markets. That was reflected in 2014. So this is a trend that's been underway, and that is with that correction, with that price decline, with that oversupply, capital is being significantly withdrawn from the business. And where the capital did come back in was in 2017 and 2018 in onshore oil shale, which we did not believe was economic at the time. Our sitting on the boards of public companies that are in the oil and gas business led us to believe that that was not an economic activity given the current price environment. And that's what you would think we've seen. So where capital has come into the market in the last 5 years, we think doesn't have sustainable production. In the current situation, undeniably, the demand for energy has temporarily and unprecedentedly declined. That's accelerating corrective processes. That's reducing future supplies. So I would suggest to you that the idea of peak oil, which is inevitable, irrefutable, will cause even, and as you see it in BP, less reinvestment in production today, which will lead to declining production, which sooner will lead to a shortage of oil before we reach peak oil demand. So the likelihood in the next couple of years that we see shortages and higher prices, in my mind, seems almost a certainty. So BP is doing something that we think is accelerating the trend underway, that's accelerating the opportunity for the investments we have in well-capitalized companies that are positioned with a differentiated business. And in the meantime, of course, there's no doubt the stock prices came down. Therefore, the value proposition improved today from where it was before. Thanks.
Great. And I guess as a quick follow-up here, we have another question that was asking you to comment on Subsea 7's ability to compete in wind tower installation against some larger entities and high-end built-for-purpose installation vessels, such as Scorpio plans to build?
So, of course, Subsea 7 is not in the turbine installation business, right? There are four components to an offshore wind field. One is the building of the foundation. Of course, historically, that's been ocean bottom. Of course, the new trend is the potential to have that as a floating production platform. Subsea 7 has been in that business from 2009 when they had an interest in Seaway Heavy Lift. They increased their position. So they do the foundation installation. The next piece of the business is to run the cabling between all of those wind turbines. Right, in 2018, they acquired from CM Offshore 2 vessels in that business. So therefore, it made them competitive in running those umbilicals, and today probably have over 30% market share in that component of an offshore wind farm. The installation of the towers is not a business that Subsea 7 is in today. And of course, the turbines themselves is a business that Subsea 7 is not in today and will never be in. So the components of the business they're in is not in tower installation, but is in the foundation installation and is in the cable lay business, which is probably around 50% of the capital spend associated with offshore wind. So we think they're well positioned. We think their competitive offering of having an integrated service solution, which they do in the oil and gas business, has a differentiation between them and some of the competitors. And so we think that's a growing component of the business with relatively little capital that's kind of gone into it. And even now, they're growing the cable lay business with a $25 billion capital investment to repurpose one of their vessels out of the oil and gas business, reducing capacity in that business and increasing their capacity in this growing business. And has a worldwide footprint, right? Because they're in, of course, the North Sea where everybody else is in Europe, but they're also in Taiwan. And they've also done work here in the US. So therefore, it's a growing footprint of business with a strong growth profile to it that is supplementing the core part of the business, which we still love. And we think it's underappreciated today. But the wind farm business, or their component in it, is actually a very interesting dynamic that we think you're kind of getting for free in that process.
Great, thanks, Bob. I have a question for both of you. Perhaps we could start with Curtis, and I think it's a very timely question. So how do you respond to those who argue that the large move to passive investing over the last decade has made it harder to succeed as an active investor? Since investing is a zero-sum game, and in order to buy, another investor needs to sell. So perhaps the dumb money has moved to passive, leaving the competition in the active space just too intense.
Well, yeah, it's no secret that there's been a tsunami of capital into ETFs and passive strategies. And if anything, the headlines over the past few years have really been the obituaries of hedge funds and mutual funds that are in the active space. So if anything, there's been sort of attrition in kind of long-only, long-term focused funds like ourselves. And if anything, it means there are fewer participants who are actually involved in the exercise of price discovery. So, between that and the kinds of opportunities that the market's always constantly churning up, in 2020 was, full of those kinds of opportunities. I think there's plenty to do for someone with the right investment time horizon and someone with the right temperament and patience.
Great, thank you.
So let me jump in on that one. So passive investing, of course, is one of the things that sets up the opportunity for stock pickers. Valuation, right? It really shouldn't be value investing. It's valuation investing. Valuation is a key part of every investment decision. It's not wonderful businesses that have great growth or wonderful companies. The question is, what price are you paying for that business? And so that's the question. The universe we're invested in, we think the valuation, of course, is getting disconnected from what the underlying cash flows of the business are. Why? Because money is mindlessly going into passive investing and going out of the stocks that we're invested in. So that's what's setting up the opportunity. The opportunity continues to grow. When's the tipping point? I don't know. That we don't all know. But the fact of the matter is, by looking at those companies, doing our individual stock analysis, understanding the cash flows of the company, understanding the value equation, the stocks we own, we know are undervalued. Many, many, many stocks today, it is a market where it is difficult to find an undervalued investor. So that's a key part. What is a value investor? What did Graham mean? Valuation matters. That's something that we think a lot of the universe, passive investing, has forgotten, because there's no regulator on the price they're willing to pay. The capital continues to flow until the point where there's a very limited risk, high risk in those situations, and a very limited risk in the cash flows and the price we're paying for those cash flows.
Great, thank you. So again, this next question, we've gotten a couple that are similar, so I'm going to try my best to combine them. It wouldn't be 2020 if we didn't discuss politics a little bit, and we have several questions asking about our thoughts on a Biden administration, how that'll affect our portfolio, and how we think about these administration changes.
So in 2018, I remember being at an investor conference, and a gentleman stood up and raised his hand and said, I have a question. How do you incorporate into your investment analysis the fact that Trump is going to have tax changes and is going to have infrastructure spend? And so I said, listen, the president of the United States is the most important person in the world. I don't think there's any dispute on that one. The fact of the matter is, those two things, one of those did not come to be. There is no infrastructure spending that came, even though, so incorporating in speculative things about the president, an administration, a government, those are all factors. The important thing is not the president of the United States. Right? The important thing is, who's the president of our company? How does he think? What's that company? What's the outlook of that business? What's its competitive position? How does he adjust to government policies, economic realities, pandemics? All those things will happen. All those will have impact on the business and its future. So the important person is not the president of the United States, because we can't predict the outcome. The president can't predict the outcome. The president doesn't know if he's going to get something done. So therefore, to have that level of uncertainty, you can't speculate and make that a key part of your investment analysis, because that's an unknowable. We are stock pickers, bottom up. We are not macro economists, because macroeconomics over time are very difficult to project. So that's not the focus of our investment approach. Where it is the president of our company, that business, its future cash flows, and how does he respond to outside events, including who's the next president of the United States.
Great, thanks, Bob. So another question actually for Bob, I think to start with. The questioner says he agrees with Curtis's comments regarding, say, value and growth being tied at the hip. So does focusing on cyclical industries make it harder to find a long-term sustained growth story?
No. So the home building situation is a perfect example. So I invested in 2009. Today is 2020, almost 2021. So we're 11 years into that process. The future of that business today, with the combination between builders and BMC, the differentiation of service offering they have, the long-term trends in that business, which have had a decade where the economy has passed it by, we think is a very long runway of opportunity. So maybe in 5 years' time, 6 years' time, that will be long in the tooth, and therefore investors will be wanting to invest in that business, and that may be something. But I'd say a 15-year time frame is a reasonably long period of time. It's not in perpetuity. So therefore, investing in perpetuity in cyclical businesses clearly has a risk, because there's some return to an oversupply situation, an overpricing situation, and overprofitability. So that's the cycle that does happen. Frequently, these businesses have a much longer period of time where that cycle plays out. And frequently, it's also not just investing in a cyclical business because of the cyclicality. There may be an idiosyncratic event that happens to a company that therefore makes a company mispriced. For example, maybe AirCap could well end up being that kind of investment over time. It was cheap before the market fell apart. It was very cheap when we got an entry point into it. The business over time has reasons to believe it's an extremely well-positioned long-term business. And therefore, we'll decide in time as that plays out. Do we want to stay continued invested? What's the market offering us for that company? How do we think about it in real time? And we don't know how that's going to play out yet. But that could well be a cyclical investment in something. The cycle was a different thing, that pandemic. So there's different things about cyclical businesses in terms of how do you define that?
Great. So our next question is probably for both of you. But one of our participants asked, do you have an opinion today on precious metals and the investment opportunity or not in the sector today?
No, I have no view on it. It's not a market I've ever focused on. I don't have a core competency in it. A lot of the things we're invested in, there's a core competency. Clearly, an entry point in today into gold is problematic. Maybe there was one 5 years ago that there were things that were value components to it. But today, I don't understand the business, and therefore, I'm not an investor in something that has appreciated some that may have a long runway of opportunity, but it's not something that I really understand the dynamics of.
I think I'm in the same camp. I haven't really focused on precious metals, and I've just kind of put it in the too hard pile.
Great, thanks. Another question we just got again for both of you is, were there any names in 2020 that you sold as a result of a change in view of the fundamentals of the business?
For me, I did sell some things, but it was not to sell it, it was to take some tax losses. So I levered into something, I bought some more. The price came down dramatically. Therefore, there was a potential for me to realize an economic value, and that is a tax loss in the process. The fact of the matter is the business and the valuation came down dramatically more than the economic future cash flows of that business condensed. So therefore, the value proposition got better in that process. And of course, that happened with a significant portion of my portfolio, right? The valuation changed dramatically. The future cash flows of the business, as we looked at it at the time, in certain cases came down, in certain cases didn't come down, in certain cases may have gone up. And so therefore, almost universally, there's not something that I sold off during the year, given the outcome, because that's what it was. The market would move much faster than the economic reality declined. So therefore, that's a mitigating reason against selling something also.
I sold off one name in particular that I had held for a few years, and that was Diamond Hill Capital. I mean, Diamond Hill, and we'll see in time whether it was a mistake or not, but Diamond Hill is a fine company, cash generative business model. It's an asset management. But the flows in the business are sort of the lifeblood of the business, and the quality and profitability of the flows is changing. So while the business will be fine, I think over time, I was less sanguine about their prospects going forward. And when I sold it, and I used the downturn in March to buy Morgan Stanley, which I felt was perhaps more undervalued and more of a battleship, more more aspects to its business in terms of durability. And so it was really substituting what I felt was maybe a higher quality franchise, a battleship, for a speedboat.
Great. I'll just kind of piggyback actually on those two things before I get to the next question, which is, when the pandemic first hit, we took a deep dive on every single name that we held, and we looked specifically at, the balance sheet, its access to financing, its survivability. That was one of the first things that we did at the onset of the pandemic to make sure that we were owning things that could survive however long the downturn would be. And with that, we did make a couple tweaks here and there to the portfolio. So the next question we have here is pretty open-ended. They're just hoping that we could talk about some of our other holdings that we haven't discussed today, some of the maybe smaller ones. They list a few here: CNQ, UMH, Jeffries, Dana, Pico. But if Curtis, Bob, if you guys just want to talk about some smaller names that we haven't discussed yet today.
Pico Holdings is a water company. We think the home building business, we looked across the entire industry. So therefore, we think that land, water, certain key assets like that are in short supply. And there's an increasing likelihood of demand of those assets, and they're mispriced and they're hard to figure out what they are. There's a lot of, land companies, water rights. What is that worth? But it's a scarce resource that actually we think is significantly mispriced. We do see, as I say, in home building, something else that we see is, HomeFed is something that we used to own an interest in. So it's a Leucadia controlled company that owns real estate, a number of places, California being a key place, Southern California being a great location. They've done a great job of accumulating assets, positioning the business. And we think there's a clear indicator of, we're on the right track, that land and development land that's likely to be developed in the short term is a very attractive asset because, of course, Jeffries was opportunistic and took that company private, issued shares in Jeffries. We think it was a great indicator that there's something that highlights and affirms an investment idea. So, I would also make reference, Jeffries is something we've owned for a long time. It's a great investment from the point of view of, the investor apathy, disappointment. Nobody wants to own the stock. It's underperformed. Therefore, capital flows out of it. And yet the businesses, there are a number of people who own significant interest in the business, think about it on a regular basis, are opportunistic. The market gives you an opportunity. It's trading for significantly less than what it's worth. So what have they been doing? They've been buying in stock and then buying in stock aggressively, highlighting the fact that smart people who are not trying to boost the stock price to get a bonus for themselves, but are looking at how to deploy capital to increase the value of the business and to do it at a price significantly less than what they believe the intrinsic value of the business to be. That's the kind of thing that populates across our portfolio that we don't occasionally talk about.
I guess one that I would highlight is FRP Holdings. It was actually, this is the very first investment I made when I joined Robotti. This is a company that's in the real estate development business. They have a very interesting and beautiful business and an aggregates royalties business. And they've also got a ton of cash on the balance sheet. And it's run by the Baker family out of Jacksonville. They are 35% owners of the stock, tremendous value creators and capital allocators. very conservative in how they approach business. And the company really has, I think, a number of interesting growth drivers, new projects that are coming on in the next 1 to 2 years and beyond. And they have a lot of embedded options in the business, entitled land and things like that, that will probably provide value in out years.
So you did mention CNQ. So CNQ is the symbol for Canadian Natural Resources, because we do think that highlights an investment theme that a number of us have, including Curtis, right? And that's mainly a Canadian oil and gas company. So, if you want to talk about like the bottom of the barrel for the last number of years, like that's it. Nobody wants to be in Canada. Everybody's leaving Canada. And so therefore, because it's the last guy along the line, the last guy to sell, he's the last guy at the marginal price and gets the lowest price. So, but we think that that's a really interesting place. The commodities are there. They're significant. They're dramatic. The opportunity to develop them better than in most parts of North America. The fact is that there are new access points to get to the world market instead of selling to the United States, which you don't want to sell to us if we're oversupplied, and that's what we've been. So the Canadian business is one in which you see capital outflow. And so Curtis has said this multiple times. That's what you want. You want an industry where there's capitulation and people are leaving. And who's buying? Canadian Natural Resources. They just bought another company again. They continue to expand their footprint, and they are buying opportunistically in a business where they have a knowledge, they have a core competency. And why is that happening? Because there's a CEO of the company who's a significant shareholder who thinks about spending capital like it's his dollars. He's creating value on a constant basis, highlighting that we do think that Canada is a really interesting place for the oil and gas business for the next decade, and significantly mispriced today, and on a risk-reward basis, very attractive.
Yeah, I think if you want to know how we find ideas, another way is to look at industries where there's capital flight. And Bob's just highlighted Western Canada. There hasn't been a worse place to be in the energy business in Western Canada, and capital has just flown out of there. And who's buying the assets? It's the locals. It's the locals that know the business best. And I have an investment in a Canadian midstream company called Tidewater Midstream, and it's really got some, I think, interesting prospects. The major delevering event in the next year, and I think infrastructure assets in and around the Canadian energy space are very interesting.
Thank you. So we've received several questions. I'm going to try to combine them. It seems that people have noticed that we're all in different locations. So the first question is, working from home, how has that affected our research process? And second, you've talked a few times about how important it is to be in touch with different management teams. How has it affected your ability to be in touch with these different management teams with so many people working remotely?
So I think actually it's very interesting. So I think, of course, the workday is effectively extended. It's no longer you come into the office at this time, you leave at that time. We're all accessing our computers and our devices constantly. And so the fact of the matter is, I would suggest is what I see as my indicators, I see people working more than they did before. And our ability to communicate with each other, it's really not, you do have all these new mechanisms, so the fact that I didn't know Zoom before. And so today, not only is it something we've been able to use today to be able to stay close together, to communicate with each other on a regular basis, but it's actually, of course, a tool that we'll have permanently. So there's some permanent improvement in terms of we got an extra mechanism. In terms of managements, the managements have been universally making themselves available. And they haven't been on the road being away from the office, which they were before. So their accessibility is actually better today, we would say, in many ways, and their willingness to be accessible today is better than what it was. So in many ways, there's a significant improvement in our abilities to communicate among ourselves, our abilities to communicate with managements. There's some trade-off, there's some negatives that kind of come from that too, but that's, the net, I think there's a net positive and a net benefit. And I also think that there's a permanency of some of the things we've picked up in the new tools that we have that will continue to be with us to be able to communicate better.
It's good news for our investors, bad news for our spouses and significant others.
And I would point out that actually Curtis is in the office, and that frequently since July, I've been in the office 2 to 3 days a week. As it turns out, I had my family down for Thanksgiving last week, and so my wife and I are isolating, hoping that, of course, none of us gave us anything, but we don't want to be interacting with people in the interim.
Great, thank you all. So we're just over an hour here, and I want to respect everyone's time. I know we have a ton of questions left here. We're going to try, actually, for any ones that we didn't get to reach out to you directly. But feel free to email us directly and ask us any follow-ups that you have. You can also email us at ir@robotti.com if you don't have any of our specific email addresses, and we'll direct it to the right person. But I'm just going to end with one last question here, which is, there are actually two of them, so I'll try and combine them. But generally, with the market kind of bouncing back and some of the rebounding that's happened towards the end of the year here with the vaccine news, has the opportunity been missed, or is there still more opportunity to be had?
I mean, I'll make a quick comment. One is, I believe there's significant opportunity existing in the portfolio as it is today, and we're finding new things. That's how we kind of spend our time. And I would say that time in the market is much more important than timing the market.
So I did see one of the questions that came off out was, gee, you know, when I look at when I hear the things that you own, frequently the names that I never heard of the company before you bought it. And so why don't you own brands? Why don't you own names that I know? Why aren't those in your portfolios? And so generally speaking, you know, we do tend to be small cap investors. And so therefore, those are companies that are less likely to be household brands. Something that's a household brand clearly is going to be a large, successful company. What that normally means, of course, is those businesses also, because of the recognition of the business and its success, frequently has valuations that are indicative of the fact that it's a successful brand. So the likelihood that we would own branded companies, the likelihood we would own largely successful companies, and we've missed plenty of investments, really the last decade, we've missed plenty of investments, not owning household names. You know, and today, you don't know what that opportunity set is there. What we do know is our companies, the competitive landscape of the people we compete with is a lot less. There are few people looking at them. So the stocks continue to get cheaper. Our understanding of those business and ability to kind of understand the dynamics in those business, you know, we think we have a leg up, and therefore provides us insight into what are the future cash flows of that business and how does that differ from the current trading price of the stock. Because that's the metric. It's not popularity and the well-known, the name of the company, but it's the investment attributes that we've determined on these companies that determine what we own and what we buy.
Thank you, Bob, Curtis, Theo, David. And thank you to everyone participating for all of your good questions over this past just over an hour now. As Theo mentioned, we did not get to all of your questions, but please feel free to email ir@robotti.com or any of us individually, and we will get those questions answered. We'll also make the recording and any associated materials available shortly after this presentation. Please note, as was mentioned earlier, the annual meeting for our global strategy managed by Isaac Schwartz is next week, December 10th at noon Eastern time. Please RSVP if you haven't done so already, or if you haven't received an invitation and would like one, please let us know. In addition, we have a number of upcoming fireside chats with the executive managements of our core holdings in the coming weeks, as well as upcoming interviews, podcasts, and articles, all of which will be announced or shared on social media, on the blog on our website at www.robotti.com, the Robotti homepage on LinkedIn, or on Twitter. The handle is @BobRobotti. Please continue to like, comment, and share so we can continue to tailor these postings to what you want to hear about. Lastly, and importantly, as you've heard from the team today, COVID has provided a generational entry point. This includes the acceleration of trends in home building and other segments that we've been noting for years, along with consolidation activity among our core themes in which we are active investors. As Bob has mentioned in the past, what we are witnessing is a veritable stock picker's nirvana. The when is now, and we are uniquely positioned given our expertise and proven edge in navigating these segments over the past 40 years as active investors in the space. We will follow up after this meeting with the necessary documents to invest or increase your investment with us. And now for final thoughts, I'll turn it back to Bob. And we thank you again for your participation and continued support. We want to wish you and your families a happy and healthy holiday season until we meet again. Bob?
Thank you, Lindsay. And once again, thank you all for being here. We absolutely appreciate your long-term investment with us. It's critical in our investment process. So again, to state we are value investors. We are unabashed value investors in a time where that label has been tarnished. We think that alone is an extra indicator of the fact that we're the right place to be today, the valuations of the companies we're invested in. So what do? It's fact-based research on individual companies, doing analysis, and it highlights the attractiveness of the investments that we're invested in today. I said our investment approach should be labeled valuation investment. Valuation matters. Valuation matters. There's a differentiator today between our investment approach and much of the market. And clearly, for Curtis to classify that as rational investment makes all the sense in the world to us. Of course, it's rational to think about valuations. That's a key component. So as I said at the start, that moniker, value investing, is something that we continue to hew to, a process that we've done for 35 years, we'll continue to do and do universally across the firm. So thank you so much again. We think it's the right place to be in the right time. And we want to thank you and thank your best wishes to you, your family's good health. We're all reminded of the importance of good health.